So how do you lower the risk? How do you protect investors for your private equity fund? You want to raise capital to invest in whatever you want, and you want to make sure that investors are protected. Here's what you need to know. And you want to make sure that you combine all these pieces and stick to the end so that you can actually have a game plan going forward. So the first way is you just have to look at the fees, look at all the possible fees you can charge investors for managing a fund. You have to look at all the ways that you can charge investors and just try to reduce those fees if applicable. So usually a fund, you have a management fee and a performance fee. Management fee is usually 2%. Performance fee, it depends. It could be 80-20, where 80% of the profits are shared with the limited partners or the investors, and then 20% is given to you. But it's usually dependent on your performance. Like if you produce over 15% returns, or over 15% internal rate of return. And internal rate of return is just a metric for seeing how well your fund is performing. But if you hit over 15%, some people say, hey, I'll split 70-30, where the investors will get 70%, I'll get 30%. So 30% would be the performance fee in that case. And then some people say, oh, if it's underneath 15% internal rate of return, then I'll split the profit share. The profit share will be 80-20, where the performance fee is only 20%, and then the investors would get the other 80%. So really, it's dependent on your niche, like whether you're doing hotels or real estate or multifamily, or you're new or you're old. But basically, you can tweak the management fee and the performance fee to see how much the investors would split, right? And so you can do that. To lower your risk. And if you're worried that investors are more skeptical, you can just give them a higher performance fee. So that's step number one. And you can also lower your management fee. So number two, another thing you can consider is, change the preferred return. So the preferred return is not actually a return. It's also called a hurdle rate. And the preferred return just means if you make over that amount in annual returns, then the general partner will start getting their fees. So some people have it so that if the preferred return is 8%, what that means is that after your returns are greater than 8%, then the general partner, that being you, the person who owns the fund, would then start getting money from those investors from the performance and the management fees even. So some people have it like that. And then other people have it so that if the pref return is underneath 8%, then that means that the general partner won't get any fees. And so that's a way of protecting investors to show that if somebody has to perform. So in other words, it's a threshold after which the owner of the fund gets their fees. If the owner of the fund doesn't perform to a certain level, then they don't get anything. So it's a way to protect the investors because it shows that the person is incentivized to get a minimum investment, like amount return. Because if they don't hit that amount, then they're not getting their own fee, right? And I'll try to say this in another simple way. Basically, it's like saying, hey, for me to be in commerce class in university, I have to get over 80%. If I don't get over 80%, then I get fired, or I get, expelled or whatever. I get expelled from the class. But if I get over 80%, then it can stay in. So similarly, it's like if you make over the pref return, then you get your fees. You can still run a fund, but you get your fees. And then if you get under it, you can still run a fund, but you lose your fees. And then the investors are just more secure because they know that there's quote unquote skin in the game. And skin in the game just means that you win, I win. You lose, I lose. So that's pretty important. So that's the second way of de-risking the fund. A third way could be doing the European style fund versus the American style fund. So the way that the European style fund works is you have somebody who, in the European style fund, the investor will get their money first before the general partner does. And it's just the order by which the cash flows. And in the American style fund, the general partner, in other words, the person that runs the fund, will get the money first before the general before the limited partners or the investors do. So America style, general partner first, the investors last. European style, investors first, general partner last. And so if you want to really protect investors, then you can just give the investors their side first before you get yours. And so that's another way to de-risk, the project. And then the last way could also be, and I'm going to throw in a bonus, just to make sure you have experience on the types of deals that you're doing. Because if you say that your fund is working on car washes, then make sure and then you only have experience in car washes, make sure you only do car washes. If you don't have experience in car washes, then you're just taking a necessary risk, and because there's no track record to point at that. And then if there's no track record to point at that, then you're asking investors to do something that you haven't done before, which is more risk. So with all those four ways, basically it's just lowering fees, performance fee and management fee. Then it's making sure that the preferred return is higher, because the higher the preferred return, the less risk investors are taking, because they know that you have to perform to a certain level before you get anything. And then afterwards, you can also consider the European style, or making sure that the investors get their money as early as possible. And finally, you can also make sure that you just focus on the things you have experience in. And all those things are obviously there are many more. And like, for example, people can even make sure that the term of the investment is long. They can even make sure the term of the investment isn't too long, because the longer the term of the investment, generally speaking, you kind of risk keeping their money in for a certain amount of time. So there are different ways to tweak it and make sure that investors feel like they're really de-risked. But overall, just make sure that you lower your fees, you decrease their risk by making sure that you have to perform a lot before you get a little. And if you just keep on doing that and just focusing on the things that you're experienced in, you can make investors feel really comfortable to work with you and to invest with you. So hey, if this is something that you like to see us help you do and get started, then just head to raises.com. But if not, just check out the YouTube channel. We don't bite, so you can learn more.